Here's a crazy fact. While most investors are celebrating 4% dividend yields, I just made around 3,000 euros in realized profits in just 60 days using covered calls, but not in the portfolio you see every week. Look at this. BITO is already paying me a 58% dividend yield on cost, and I could be collecting another 25 to 30% annually through covered calls on top of that. I am the ex-financial advisor who allocated over 10 million in European assets and built this 25% yielding portfolio in 3 years. If you are sitting on gold mines like this BITO position without monetizing the options premium, you are leaving thousands of euros on the table every year. Today I'm showing you how I would stack covered calls on top of these massive distributions, the strategy I keep private to protect my 3,670 subscribers from their own greed. Welcome back to the channel where I show you strategies that actually work, but today I'm revealing something that's going to blow your mind. Look at this screen. My BITO position is paying a 58.32% dividend yield on my cost basis of $18.79. That's $25,519 in annual distributions on 47,000 investment. But here's the insane part. I could be stacking covered calls on top of these distributions for potentially another 15 to 20,000 annually. We are talking about total yields exceeding 80–90% annually from a single position. This 3,000 euros in 60 days from my private portfolio, that came from doing exactly this strategy on similar high distribution positions. I've been quietly running covered calls on top of massive dividend yields while my public portfolio just collects the distributions like a normal investor. I'm your host, former financial advisor who allocated over 10 million across European markets. I've got 3,670 subscribers following my public portfolio journey, and today I'm explaining why I deliberately don't stack covered calls on top of these monster dividend yields publicly, even though it could potentially triple my total returns. The reason? Because when people see 80–90% total yields, they lose their minds and make catastrophic decisions. But you are ready for the truth about yield stacking. Before we dive into this yield stacking strategy, understand what you are looking at. BITO isn't just some random crypto ETF. It's become a distribution monster, paying $11.91 annually on shares I bought for $18.79. That's a 63.44% internal rate of return and a 58% current yield that most investors can only dream about. But here's what we are covering today that could change everything. First, how BITO's distribution strategy creates perfect covered call opportunities. Second, why high yield positions like this are actually safer for covered calls than traditional stocks. Third, the mathematics of stacking 30% options income on top of 58% distributions. Fourth, why I keep the strategy private despite the incredible returns. And finally, how you could implement this responsibly without destroying your account. With almost 4,000 people watching my public portfolio moves, if I started posting 90% total yield strategies, the chaos would be unimaginable. People would mortgage houses, raid retirement accounts, and leverage themselves to destruction chasing these numbers. So I keep the strategy private while using my public portfolio to demonstrate the foundation. But today I'm making an exception to show you the framework. Let me break down the mathematics of what we are really looking at here. Because when you see the numbers laid out, you'll understand why the strategy is so powerful and why it requires extreme discipline. My BITO position consists of 2,520 shares purchased at an average cost of around $19, totaling around $47,000 in capital deployed. At the current prices, around $20.50, the position is worth roughly $51,000 with an unrealized gain of $4,000. But the real magic happens in the income generation, not the capital appreciation. BITO's distribution pattern over the past years shows the volatile nature of these payments. We've seen everything from 0.36 per share in April 2025 to $1.20 per share back in September 2024. My 2,500 shares have been collecting these monthly distributions, and even with this volatility, the annual rate projects to $11.91 per share. On my cost basis of 47,000, that's a yield of 63%, but the conservative forward estimate shows 25,519 over the next 12 months. Now here's where the covered call stacking becomes mathematically compelling. Based on my private portfolio results with similar high volatility positions, I could realistically target 2 to 3% monthly premiums from covered calls on BITO. That's around $1,000 to $1,500 monthly on the current position value of 51,000. Actually, we are looking at 12,000 to 18,000 in additional covered call income. The combined mathematics become absolutely staggering when you add these income streams together. Conservative annual distributions of $25,000 plus moderate covered call premiums of $15,000 equal $40,000 total annual income from a $47,000 investment. That's an 85.5% total annual yield from a combination of strategies most investors never consider. But here's what makes this strategy actually safer than traditional covered calls. BITO's high distribution yield means I'm getting paid substantial income even if I never sell a single call option. The covered calls become pure bonus income rather than the primary return driver. If options markets become unfavorable or volatility drops, I still collect those massive distributions. BITO's Bitcoin correlation creates consistently high implied volatility, which translates directly to higher options premiums. While traditional dividend stocks might offer 1 to 2% monthly option premiums, BITO regularly provides opportunities for 3 to 5% monthly returns from covered calls due to crypto market dynamics. This volatility premium compensates perfectly for the additional complexity of managing options on top of distributions. The timing coordination requires working with BITO's monthly rhythm rather than trying to predict distribution amounts. Since distributions are announced very close to ex-dividend dates, I focus on the pattern. Typically, first few days of each month for ex-dividend dates, with payments following about a week later. This predictable schedule allows strategic covered call timing even without knowing exact distribution amount in advance. This might sound counterintuitive, but high-yield distribution positions like BITO are actually safer for covered call strategies than traditional dividend stocks, and I am going to prove this to you mathematically. Traditional covered call wisdom suggests using stable, low-volatility dividend stocks because they are safer. But this creates a fundamental problem. When you are collecting 2 to 3% annual dividends and targeting 1 to 2% monthly option premiums, the options become your primary income source. If anything goes wrong with your covered calls execution, your total returns collapse because you are not getting meaningful income from the underlying asset. With BITO paying 58% distributions, the dynamic completely reverses. The distributions become my primary income source, generating more than most people's entire portfolio returns. Covered calls transform from necessity into pure bonus income. If I mess up an options trade, I miss a month due to unfavorable conditions or get assigned an inopportune times, I'm still collecting those massive distributions. This income diversification provides enormous psychological advantages for covered call execution. When you are not dependent on option premiums for your returns, you can be much more selective about strike prices and timing. I can afford to sell calls further out of the money because I'm not chasing every last dollar of premium to meet returns targets. The assignment scenario reveals another crucial advantage. If my BITO shares get called away at 25 while I'm collecting 11.91 annual distributions, I've made 6.21 per share capital gain, plus whatever option premium I collect. That's a 33% capital gain, plus option income, plus any distributions received during the holding period. More importantly, if I get assigned, I can immediately rebuy BITO shares and restart the entire strategy. Unlike traditional stocks where assignment might occur during temporary price peaks, BITO's volatility means assignment often happens during momentum moves that quickly reverse. This creates opportunities to rebuy shares at similar or better prices within weeks of assignment. The volatility that scares most investors away from BITO actually creates superior covered call conditions. High implied volatility means higher option premiums without requiring closer strike prices. I can sell calls 12 to 15% out of the money and still collect meaningful premiums because BITO's option pricing reflects Bitcoin's inherent volatility. Traditional safe dividend stocks often force traders to sell calls at 5 to 8% out of the money to generate decent premiums. This dramatically increases assignment probability and reduces upside participation. With BITO, I get higher premiums from safer strike prices, creating better risk-adjusted returns. BITO's distribution model provides another layer of safety most people overlook. These distributions come from Bitcoin futures contango and volatility, not company earnings that can be cut during recessions. While distributions amounts fluctuate with Bitcoin performance, as we see in the history ranging from $0.36 to $1.2 monthly, they are not subject to corporate dividend policy changes or earnings disappointments. This means I can build long-term strategies around BITO's distribution profile without worrying about surprise dividend cuts that destroy covered call strategies on traditional stocks. The predictability of receiving substantial distributions, even if amounts vary significantly month to month, provides a stable foundation for option strategies. During market corrections, when traditional dividend stocks decline 20 to 30%, BITO might decline similarly. But I'm collecting 58% annual distributions while it recovers. Those distributions provide enormous downside protection that traditional 2 to 3% dividend yields simply cannot match. Even if BITO stays flat or declines moderately, I'm generating returns that exceed most investors' best years. Okay, now I'm going to reveal the exact framework I use in my private portfolio for stacking covered calls on high distribution positions, because this systematic approach is what generated those €3,000 results in 60 days. The foundation starts with working around BITO's monthly distribution rhythm rather than trying to predict exact amounts. Since BITO typically announces distributions very close to ex-dividend dates and those ex-dividend dates fall in the first few days of each month, I built my covered call strategy around this predictable timing pattern rather than waiting for distribution announcements. Strike detection follows modified rules designed specifically for high distribution assets. Because I'm already collecting massive income from distributions, I can afford to be more conservative with strike prices. My minimum is 12% out of the money, often targeting 15 to 18% for additional safety margin. With BITO at 20.43, this means strikes of 23 to 24 minimum, providing substantial upside participation while generating meaningful premiums. The highest strikes work because BITO's volatility creates option pricing that remains attractive even at these safe levels. Where traditional stocks might offer 0.3 to 0.5 premium for 15% out of the money calls, BITO consistently provides 0.5 to $1.2 for similar relative strikes. This volatility premium allows conservative positioning without sacrificing income generation. My execution timing follows a systematic approach based on BITO's distribution calendar and Bitcoin's market patterns. The optimal strategy revolves around the monthly ex-dividend cycle. Immediately after ex-dividend date, when BITO typically drops by the distribution amount, I analyze the option chain for the following month. This timing captures any elevated volatility from the price adjustment while ensuring I've secured the distribution payment. I specifically avoid selling calls during Bitcoin conference weeks, major regulatory announcement periods, or within 48 hours of Federal Reserve meetings. The systematic approach removes emotional decision-making that destroys most option traders. Since I can't predict whether the next month distribution will be 0.4 or $1, I focus on the rhythm and let the distributions be whatever they are. The monthly distribution cycle creates a natural rhythm for covered call management. In the first week of each month, around X dividend dates, I focus on capturing distributions and avoid new option sales. In the second week, after distributions are secured and any price adjustment have occurred, I sell new covered calls for the following month. And the third and fourth weeks involve monitoring positions and preparing for the next cycle. This systematic approach works regardless of whether BITO announces 0.4 or $0.2 distributions for any given month. The strategy adapts to the distribution amounts rather than trying to predict them, which removes a major source of timing errors that plague most dividend-focused option strategies. Position scaling follows strict rules designed to prevent overconcentration despite attractive returns. Maximum 40% of total portfolio in any single high distribution covered call position, regardless of how compelling the mathematics appear. The remaining 60% stays in diversified assets including other covered call positions, growth stocks, and cash reserves for opportunities. This scaling approach recognizes that 90% total yields are unsustainable indefinitely. Distribution rates fluctuate dramatically with Bitcoin performance, option markets experience periods of low volatility, and concentration risk increases dramatically at high allocation levels. The framework prioritizes sustainability over maximum short-term returns. Now I need to explain why strategies capable of generating 80 to 90% annual yields remain private despite their effectiveness, because understanding this psychology is crucial for your long-term success. When I post about BITO's 58% distribution yield, I already see comments from people planning to sell everything and buy only BITO. Imagine the response if I showed how to potentially double that through covered calls. Within hours, my inbox would fill with messages from people borrowing money, liquidating retirement accounts, and leveraging themselves beyond any reasonable risk tolerance to chase these returns. The mathematical seduction becomes overwhelming for most retail investors. They see 40,000 annual income from a 47,000 investment and immediately calculate how 200,000 could generate enough income to quit their jobs. They ignore distribution variability, the fact that BITO paid 0.36 one month and $1.20 another month, options market cycles, concentration risk, and their own emotional capacity to handle volatility. The strategy that works at 40% portfolio allocation becomes catastrophic at 100 allocation. This scaling problem explains why I maintain strict position limits even in my private portfolio. The temptation to increase allocation becomes intense when you are generating these returns, but market history shows that unsustainable strategies eventually revert violently. BITO's distributions could decrease if Bitcoin futures markets change structure, dropping from $20 monthly back to 0.36 or lower. Options volatility could collapse during extended low volatility periods. Concentration risk could destroy accounts during systematic corrections. So with almost 4,000 subscribers, showing 90% yield strategies creates massive amplification of bad decisions. Even if only 10% of subscribers attempt to replicate these results inappropriately, that's 367 people potentially making life-altering financial mistakes. The moral weight of potentially contributing to financial destruction far outweighs any educational benefit from showing advanced techniques. The feedback loop becomes destructive quickly. When people copy high-yield strategies and initially succeed, they increase position sizes and risk levels. When inevitable corrections occur, like when BITO distributions drop from $20 to $0.36 in a single month, they panic and make emotional decisions that lock in massive losses. Then they blame the strategy or the person who shared it rather than taking responsibility for their own risk management failures. My public portfolio serves a completely different purpose than private wealth optimization. Public execution teaches fundamental principles that apply across all market conditions and investment approaches: patience, research, position sizing, and emotional control create lasting wealth regardless of specific strategies or market environments. But showing 90% yield strategies publicly encourages speculation over education. People focus on copying specific trades rather than developing the underlying skills required for long-term success. They want the results without building the foundation, knowledge, and emotional maturity that makes those results sustainable. Let me be brutally honest about what can destroy you with high-yield covered call strategies, because these risks are amplified and most people ignore them completely. BITO's 58% yield creates false security. You think you are safe collecting massive income, but look at the distribution history. I mentioned it 1000 times probably in this video. Distributions dropped from $1.20 down to 36 cents per share within a month. That's a 70% income drop that can happen in quarters, not years. So when your entire strategy depends on high-yield distributions, this volatility becomes catastrophic. Concentration risks explodes with attractive returns. When one position generates 40 to 50% of your portfolio income, you'll be tempted to increase allocation. This is exactly how accounts get destroyed. My private portfolio dropped 18% in 2 weeks during Bitcoin regulatory fears, while distributions simultaneously fell from $1 to 54 cents. Stock losses plus income reduction offset weeks of premium collection instantly. BITO creates unique dangers that don't exist with normal stocks. Bitcoin moves 24/7 while option markets are closed, so BITO can gap up to 8 to 10% overnight and instantly put your sold calls deep in the money with zero chance to adjust. You wake up to forced assignment during momentum moves that continue beyond your strike prices. Then implied volatility can collapse 60 to 80% within days during Bitcoin calm periods, and that would crush option premiums. Market structure changes could eliminate the entire strategy if Bitcoin futures contango disappears permanently. The difference between $1.20 and 0.36 monthly distributions represents fundamental shifts completely outside of your control. So, we've just explored the most advanced yield stacking strategy from my private portfolio. The mathematics are undeniable but highly variable. My 58% BITO distributions plus 25 to 30% covered call income represents wealth acceleration most never experience. But these returns aren't guaranteed or sustainable indefinitely. Distribution history shows the reality. Good month could exceed 100% annualized yields. Challenging month might drop to 30 to 40% annualized. For the small percentage ready for this complexity, follow strict guideline. Maximum 10% portfolio allocation regardless of attractive returns. Paper trade for 3 months minimum before risking real capital. Develop written exit criteria including distribution level triggers. Treat this as advanced portfolio management, not primary wealth building. I keep this strategy private in my public portfolio to protect 3,500 subscribers from their own potential greed. My responsibility to the community outweighs personal profit optimization. But understanding what's possible provides context for my consistent, boring strategies often produce superior long-term wealth. If this provided valuable insights while reinforcing proper risk management, subscribe and share responsibly with only experienced investors. Stay disciplined, respect the massive risks, and remember that consistent compound growth always beats spectacular flameouts. If you are a European investor wondering how to access US ETFs like BITO despite EU regulations, I've got a separate video breaking down the cash-secured put option strategy that makes this possible legally from Europe. Stay psycho, stay profitable, and watch that last video.